Imagine a GPS system, right? And it doesn't just tell you that you made a wrong turn. Like, it doesn't just recalculate.
Right.
It actually reaches out, takes control, and shuts off your car's engine right there on the highway.
Which is terrifying to think about.
Yeah, exactly. But today, we're looking at a stack of enterprise architecture research and global compliance reports that show governments around the world are basically doing exactly that. They're installing that exact kind of GPS deep inside corporate billing systems, and it is completely rewriting what it means to run a business.
It really is. It's this massive but, relatively hidden upheaval. We're talking about a fundamental shift in how corporations interact with tax authorities. And it's taking one of the most historically overlooked departments and turning it into the literal nerve center of the entire enterprise.
Right, because when we think about corporate structures, we all have these like built-in assumptions. Sales makes the money. R&D invents the future. And tax. I mean, the traditional image of the tax department is basically a group of people sitting in a quiet, slightly dusty room, staring at a mountain of last year's receipts.
Oh, 100%. They've been the ultimate historians.
Yeah.
Their entire job was just to, look backward, figure out what happened, and just make sure the company didn't get fined.
Just keeping everyone out of jail, basically.
Exactly. For the last 2 decades, that reactive posture was the fundamental reality for the global head of indirect tax. The business went out, they sold products, bought supplies, generated tax obligations, and the tax team just sat downstream.
Catching whatever flowed down to them.
Right. At the end of the month, they'd gather up the data, interpret the rules, file the returns, and manage the risk. It was purely defensive.
But based on the research we're diving into today, that dusty room is just, it's gone. Okay, let's unpack this. Our mission for this deep dive is to explore how a massive technological shift has taken the global head of indirect tax, what sounds like, honestly, the driest compliance role in the world.
It really does.
And it quietly transformed them into one of the most powerful strategic leaders, IT architects, and intelligence gatherers in a modern company.
And for you listening, whether you're in marketing, supply chain, or engineering, this is a masterclass in adaptation. This is a blueprint for how a sudden technological shift can take a purely administrative back-office cost center and transform it into the ultimate strategic weapon. It changes the entire value of the data a company is already generating.
So, to understand how a tax specialist becomes a strategic weapon, we first have to look at how the actual mechanics of compliance have, well, flipped completely upside down. The reports point to a catalyst called continuous transaction controls, or CTCs.
Right, CTCs.
Let's get into the weeds here. What does this actually look like on the ground?
So the catalyst is that more than 100 countries are suddenly converging on real-time reporting standards.
Wow, 100.
Yeah, it's global. And under CTCs, the government is no longer willing to wait for a spreadsheet at the end of the month. Instead, the tax authority essentially wedges itself into your sales process. They want to validate an invoice before it reaches your customer.
Wait, before?
Before.
So it's not a historical review anymore. It's an actual live operational hurdle.
Exactly. The compliance check is happening at the literal speed of business. The moment you hit send on a bill, the data zips to a government server, gets checked against their logic, and if it passes, they issue a digital token that allows the invoice to actually go to the client.
Which brings us back to that GPS analogy, right? I mean, if you think about moving from checking your rearview mirror, which is the old way, to having a GPS that actually controls your engine in real time. If the tax authority system doesn't like the route if there's a typo in the tax rate or a missing field, the car just stops.
The transaction is frozen.
That is wild.
And to take that GPS analogy a step further, if that engine shuts off, it's not just the driver who suffers. The entire supply chain behind them just piles up.
Oh, of course.
If the tax logic is wrong, the invoice is rejected, the customer doesn't get billed, the accounts receivable department is left waiting, and revenue stops dead in its tracks.
Okay, but if I'm playing devil's advocate here, if I'm the chief information officer, I'm looking at this and thinking, okay, this is all happening deep inside the software stack, right?
Sure.
I just buy some off-the-shelf software to handle this, plug it into the ERP, the Enterprise Resource Planning System, our central corporate nervous system, and I tell the tax team to just go back to their spreadsheets. Wait, if this is all happening in the tech stack, isn't this just an IT problem now?
What's fascinating here is that our sources explicitly warn that this exact mindset is the fastest way to paralyze a company.
Really? Paralyze?
Completely.
Yeah.
Because, look, the IT team knows how to install the software, right? but they don't know the localized tax logic.
Oh, I see.
If IT builds this architecture without deep tax guidance, or, on the flip side, if the tax teams just throw their hands up because they're afraid of the technology, you get systems that are technically implemented, but substantively flawed.
Substantively flawed, meaning it works, but it's doing the wrong thing.
Yes. The software turns on, the lights are blinking, but the logic inside it is illegal.
So it just fires off beautifully formatted XML files that the government immediately rejects.
Exactly.
Ah.
Which means your billing grinds to a halt anyway. This is why the global head of indirect tax has to step up and become what the research calls an architecture sponsor.
Architecture sponsor.
Yeah. They can't just consume IT's decisions after the fact anymore. They have to be in the room during ERP migration design sessions. They need to specify the exact compliance logic for the data orchestration layer.
Wait, data orchestration layer. Okay, for those of us who don't live in the IT basement, you're basically talking about the digital traffic cop, right?
That's a great way to put it, yeah.
The software that translates our internal sales data into whatever specific digital format the government is demanding that day.
That's exactly it. It routes and translates the data. But the tax leader has to dictate the rules the traffic cop enforces. They have to evaluate vendor architectures based on actual granular regulatory requirements, not just, shiny sales brochures.
That is, you're taking someone trained in tax law and asking them to help design the enterprise technology stack.
It's a huge pivot.
It's a massive pivot. And it makes me wonder, if the head of tax is now this architecture sponsor, how do they actually ensure that these machines, these automated agents, are doing their job correctly every single day? Because you aren't managing human accountants with calculators anymore. You're governing code.
Right. And the sources break this new technology governance responsibility down into 3 distinct pillars.
Okay.
Let's look at the first one, logic governance. The executable code sitting in these automated systems is literally the modern expression of tax law.
So let's say a government, let's go with Italy, suddenly decides to add a new mandatory field to all electronic invoices. Or they tweak a regional tax rate.
Happens all the time.
Right. So the question for the tax leader today isn't just, what does the new Italian law say? The real question is, does our software logic accurately implement this new law without breaking our sales process?
Precisely.
How do they actually do that?
They have to get their hands dirty. The tax team literally works in sandbox environments now.
Like IT sandboxes.
Yes. They simulate the new Italian invoice requirements, push test data through the logic engine, and verify that the output perfectly matches the new regulation before it goes live. They are governing the logic to ensure the executable code matches the shifting regulatory reality.
That makes total sense. Okay, what's the second pillar?
Performance governance.
Right.
Because once the logic is live, you can't just walk away. You have to continuously monitor the automated systems.
Because things break.
Constantly. Let's say your automated agent flags a sudden, 5% rejection rate on invoices in Brazil. The tax leader doing performance governance doesn't just pass that to IT. They dig into the rejection codes themselves. They might find that a specific warehouse is inputting zip codes in the wrong format, causing the government's validation engine to kick it back.
Oh, wow. So it's not even a tax error, it's a data entry error.
Exactly. But tax catches it. The tax team finds the root cause, works with operations to fix the data entry, and clears the bottleneck. They are exercising real-time oversight to ensure the company is genuinely compliant, not just operationally functional.
So they're the mechanics keeping that GPS engine running smoothly.
Yep.
And the third pillar.
Vendor and partner governance. Global compliance isn't something you build entirely in-house anymore. It requires a massive ecosystem of technology providers, local compliance partners, and government-certified routing networks.
Right. You can't build it all yourself.
No way. So the head of tax has to govern this entire network. They have to stress test these vendors to see whose coverage in a given country is genuine and whose is merely aspirational.
Aspirational. That is a very polite corporate way of saying the vendor is completely overpromising and under-delivering.
It's a huge risk. If an aspirational vendor's network goes down, the company can't legally invoice its clients. So the head of tax is actively managing these service-level agreements, demanding uptime metrics and ensuring continuous compliance.
Okay, so the tax leader is now deep in the IT stack. They're governing logic, monitoring performance, managing a web of tech vendors. But if we step back from the pure mechanics of this, the sheer act of monitoring this code produces something else entirely. Here's where it gets really interesting. What is the actual byproduct of all this real-time monitoring?
The byproduct is unprecedented visibility. Every single real-time compliance process generates something far beyond its regulatory purpose. By feeding all this data through a central real-time validation engine, the tax department is creating a continuous validated transaction-level record of the organization's entire global financial activity.
Let that sink in. Every purchase of raw materials,
Yep.
every sale to a consumer, every intercompany transfer between subsidiaries.
All documented the exact second it happens, all validated against strict government regulatory standards, and all highly structured.
But the tragedy, and the research points this out as a massive lost opportunity, is what happens to this data in most companies right now. It flows in a completely linear pipeline.
Right.
It starts in the ERP system, flows through the compliance platform, goes straight to the tax authority to satisfy the law, and then it's basically discarded.
Yeah, it's treated as a pure compliance artifact.
It's just a box you check and then you move on.
Exactly.
I mean, it's like generating a microscopic, real-time health diagnostic of your entire company every single second, using that incredible data to pass a single emissions test, and then throwing the diagnostic report in the trash.
To stick with that diagnostic report analogy, it's not just that you're throwing it away.
Yeah.
You're throwing away a report that tells you exactly which supplier's engine is about to blow up and exactly how much fuel you are wasting across your entire global fleet. That is what our sources mean when they talk about a fundamental shift in the professional value proposition of the tax leader. A leader who simply manages the emissions test is defensive, to prevent fines. But the leader who extracts the diagnostic data and builds a pipeline to actually use it, they are creating offensive value.
Offensive value, I love that. They're using data they were forced by the government to collect to actually help the company make money or avoid massive business risks.
Exactly.
And they are operating from a unique vantage point. Nobody else in the company has data this complete, this high quality, and this thoroughly validated, because nobody else is forced to report it to a government in real time.
Which brings us to how they deploy this offensive value. To do this, the head of tax has to break out of their historical silo. They have to take this treasure trove of data and walk it straight into the C-suite. The sources outline 3 massive strategic conversations the global head of tax should be having with the CFO right now.
Let's break these down, because this is where the theory hits the bottom line. Conversation number 1, working capital.
So VAT value-added tax represents a massive working capital variable for any global enterprise. To put it simply, every time a company buys something, they generate an input VAT claim. The government essentially owes them a bit of change.
Okay.
Every time they sell something, they generate output VAT, meaning they owe the government.
Right, and managing the timing of those billions of pennies across 50 different countries is what makes or breaks a company's cash flow.
And traditionally, the Treasury Department is trying to manage this blindly, just relying on estimates. But think about a global manufacturer. They buy $50 million in parts in Germany, generating a massive VAT refund claim. They sell the finished goods in Japan, creating a payment obligation. The new head of tax, with their real-time architecture, knows the exact status of both of those obligations at any given second.
So instead of the Treasury team borrowing millions of dollars at high interest rates to cover a localized shortfall, the tax leader can say, wait, we have validated refund claims clearing in Germany tomorrow. Don't borrow the money.
Yes, they are liberating cash in real time.
It's essentially found money for the CFO.
It really is.
Ah.
Now, the second conversation is entirely different. It's about supply chain risk.
I have to stop you here, because when I read this part of the research, I was genuinely confused.
It's a leap, yeah.
Hold on. How does an invoice tax validation save the supply chain? What does the tax department have to do with whether a supplier in Taiwan delivers their microchips on time?
It's all about the hidden early warning systems embedded in continuous transaction controls. When you submit an invoice through these real-time government portals, the system isn't just checking your math. It's validating the active registration status of the counterparty, the supplier you're buying from.
Okay.
The government is running a split-second health check to see if that supplier is legally compliant.
Okay, so if a supplier suddenly fails that validation, if the government system kicks back an error saying, this vendor's tax ID is suspended.
It is not a minor IT glitch. It is a flashing red light of severe business distress. Think about it. If a company stops paying its taxes or fails to maintain basic government registrations, they're usually in deep financial trouble.
Oh, wow.
And the procurement team, the people waiting for those microchips, they have no idea this is happening. They won't know until the shipment simply fails to arrive 3 weeks from now.
If you're listening to this and you've ever dealt with a critical vendor who suddenly folded and couldn't fulfill an order, you know the absolute chaos that ensues. What the research is saying is that the tax department actually knew that vendor was going under weeks ago, but because they were locked in their silo, nobody told you.
But the strategic head of tax sees that failed invoice pinging immediately. They route that intelligence directly to supply chain leadership. They say, hey, vendor X just failed a basic compliance check in Taiwan. You need to spin up a secondary supplier right now.
That's amazing.
They identify the risk before the disruption even occurs. The tax department literally becomes a real-time radar for the supply chain.
That is incredible. Using a mandatory compliance check as a corporate espionage tool, essentially. What's the third CFO conversation?
The regulatory entry strategy conversation. When a company wants to enter a new country, let's say they want to launch operations in an emerging market in South America.
Okay.
Traditionally, business leaders look at demographics, consumer demand, and logistics. Tax is treated as an afterthought, something to figure out later. But the head of tax has the earliest and most granular visibility into the digital infrastructure required to legally operate there.
Because they're the ones who have to build the logic to connect to that government's servers.
Right. They can look at the market and tell the CFO, listen, the consumer demand is great, but their local tax authority requires a hyper-complex, localized e-invoicing architecture that will cost us $3 million to build and take 2 years to implement.
Wow.
They dictate whether a market is actually commercially viable based on the hidden cost of compliance.
So if the head of tax is going to have these three massive conversations, optimizing global cash flow, saving the supply chain from collapsing, and dictating international market entry, they clearly cannot be spending all day manually checking receipts or putting out minor fires. They need a completely different relationship with time.
Which requires a shift from being purely reactive to what the sources call the regulatory anticipation mandate.
Anticipation mandate.
Yeah, because the global indirect tax landscape is incredibly volatile right now. You have the OECD, the Organization for Economic Cooperation and Development, which essentially helps set global economic policies, and individual nations constantly harmonizing frameworks, rolling out new mandates, and changing digital formats.
And if you are a company that just sits back and waits for a local government to finalize a law before you respond,
You are dead in the water.
yeah.
You are perpetually scrambling, managing compliance crises day after day, paying exorbitant rush fees to IT vendors just to keep your billing systems legally functional. The strategic head of tax operates on an 18-month anticipation mandate.
18 months.
Always. They are constantly monitoring the global regulatory horizon, participating in government consultations, and translating those emerging requirements into architectural IT investments 18 months before a mandate actually goes live.
So what does this all mean? The actual makeup of the tax department has to change, right? You can't just fill the room with tax lawyers and accountants anymore.
The entire function has to be structurally rebuilt. Deep regulatory expertise is still the foundation, of course.
Yeah.
But today, you need professionals who can translate an abstract tax law into executable binary logic for an automated system.
Right.
You need data analysts who can mine that real-time transaction data for the supply chain intelligence we just talked about. You need tech governance experts.
They have to come out of the basement and integrate.
They must operate in deep, continuous alignment with IT, finance, treasury, and procurement. Building this new team requires a deliberate investment in hiring, training, and cross-functional design. But the payoff is undeniable. Organizations that are architecturally ready for these mandates 18 months in advance absorb the cost of compliance at a fraction of what their reactive competitors pay.
That makes total sense.
It stops being about risk management
Yeah.
and becomes a profound competitive advantage.
It is wild to think about the journey of this role. We started this deep dive talking about a downstream back office historian staring at old receipts. But what we've actually uncovered is a transformation into a strategic enterprise architect.
Completely.
The global head of indirect tax is quietly taking control of the most vital flow of real-time intelligence in the entire enterprise. As the research puts it so perfectly, they aren't just performing a tax role anymore. They are performing one of the most strategically significant roles in the modern business world.
If we connect this to the bigger picture, the overriding lesson is about where true value comes from in the digital age. Organizational value isn't always about going out and buying expensive new data streams or inventing entirely new metrics. Often, the most powerful thing you can do is look at the massive amounts of data you were already forced to collect for boring administrative reasons and simply build the architecture to actually use it.
Yeah.
The asset already exists, It's the perspective that needs to change.
It's about looking at mandatory corporate chores through a strategic lens, which leaves us with a pretty fascinating question for you to ponder on your own. If tax, the ultimate dry mandatory compliance function, is secretly sitting on the most valuable real-time strategic data in the company, what other boring administrative data in your own organization or your own industry is actually a gold mine, just waiting for the right person to look at it differently?
That's the real question.
The dusty basement isn't just an archive anymore. With the right architecture, it might actually be mission control. Thanks for joining us on this deep dive.